Roth IRA versus traditional IRA, one makes you richer. Here's which one wins and why. The difference comes down to taxes. With a traditional IRA, you get a tax deduction now but pay taxes later when you withdraw. With a Roth IRA, you pay taxes now but withdraw tax-free in retirement. The right choice depends on your current income, your future income, and your tax strategy. Today I'm breaking down both options, showing you the math, and revealing which one builds more wealth for most people. What is a traditional IRA? A traditional IRA is a retirement account where you contribute pre-tax dollars. You get a tax deduction in the year you contribute, which lowers your taxable income. The money grows tax-deferred, and you pay taxes when you withdraw in retirement. How it works: let's say you earn $50,000 per year, and you contribute $6,000 to a traditional IRA. That $6,000 reduces your taxable income to $44,000. You pay less in taxes today. The money grows tax-free while it's in the account. If you invest in index funds and average 10% annual returns, your contributions compound without the IRS taking a cut every year. But when you retire and start withdrawing, every dollar you take out is taxed as ordinary income. If you're in the 22% tax bracket in retirement, you'll pay 22% on every withdrawal. Contribution limits for 2024 and beyond: under 50 years old, up to $7,000 per year; 50 and older, up to $8,000 per year. Catch-up contribution income limits. Anyone can contribute to a traditional IRA, but the tax deduction phases out at higher incomes if you or your spouse have access to a 401k at work. Check IRS guidelines for current phase-out ranges. What is a Roth IRA? A Roth IRA is a retirement account where you contribute after-tax dollars. You don't get a tax deduction now, but all growth and withdrawals in retirement are completely tax-free. How it works: you earn $50,000 per year and contribute $6,000 to a Roth IRA. You pay taxes on the full $50,000, no deduction. But once that money is in the Roth, it grows tax-free forever. When you retire, you withdraw tax-free. If your Roth has grown to $1 million, you take out $1 million and pay zero taxes. The IRS never touches it again. Contribution limits for 2024 and beyond: under 50 years old, up to $7,000 per year; 50 and older, up to $8,000 per year. Income limits. Roth IRAs have income limits. If you're single and earn over a certain threshold, check current IRS limits. It's around $150,000 for 2024. You can't contribute directly to a Roth. If you're married filing jointly, the limit is higher, around $230,000. If you earn too much, you can use a backdoor Roth IRA strategy, which involves contributing to a traditional IRA and then converting it to a Roth. Consult a tax professional if this applies to you. Traditional IRA: pros and cons. Pros: tax deduction now. You lower your taxable income in the year you contribute. If you're in a high tax bracket, this saves you money today. Lower taxable income helps with other benefits. Reducing your taxable income can qualify you for other tax credits or reduce your adjusted gross income, AGI, which affects things like financial aid, insurance subsidies, and more. Good if you expect to be in a lower tax bracket in retirement. If you're earning a lot now but plan to live on less in retirement, paying taxes later at a lower rate makes sense. Cons: you pay taxes on withdrawals. Every dollar you take out in retirement is taxed as ordinary income. If tax rates go up, you're stuck paying higher taxes. Required minimum distributions, RMDs. Starting at age 73, as of 2024, you're forced to withdraw a certain amount every year whether you need the money or not. Those withdrawals are taxable, less flexibility. If you need to access money before 59 and a half, you pay taxes plus a 10% penalty on earnings. Roth IRA, pros and cons. Pros, tax-free growth and withdrawals. You never pay taxes on the growth or the withdrawals. If your Roth grows to $2 million, you keep $2 million. No required minimum distributions. You never have to withdraw if you don't want to. You can let it grow indefinitely and pass it to your heirs tax-free. Flexibility. You can withdraw your contributions, not earnings, at any time without penalty. This makes it a pseudo-emergency fund, though you shouldn't use it that way. Hedge against future tax increases. If tax rates go up, you're protected. You already paid taxes at today's rate. Cons. No tax deduction now. You pay taxes on your full income, which means less immediate tax relief. Income limits restrict access. High earners can't contribute directly without using backdoor strategies. Only beneficial if you expect higher taxes in retirement. If you'll be in a lower tax bracket later, the Roth might not provide as much benefit. The math. Roth versus traditional. Let's compare two scenarios. You're 30 years old, and you contribute $6,000 per year for 35 years. Your investments average 10% annual returns. Scenario 1. Traditional IRA, you contribute $6,000 per year pre-tax. Over 35 years, your account grows to approximately $1.7 million. When you retire, you start withdrawing. Let's say you're in the 22% tax bracket. You pay 22% on every withdrawal. If you withdraw $60,000 per year, you pay about $13,000 in taxes, leaving you $47,000 to spend. Scenario 2. Roth IRA, you contribute $6,000 per year after tax. Over 35 years, your account grows to the same $1.7 million, same contributions, same returns. When you retire, you withdraw tax-free. If you withdraw $60,000 per year, you keep all $60,000. No taxes. Over a 30-year retirement, the Roth gives you an extra $13,000 per year, $390,000 more in after-tax income. The Roth wins if tax rates stay the same or go up. For a comprehensive guide to retirement planning and wealth-building strategies, check out Money, Master the Game by Tony Robbins. It breaks down complex strategies in simple terms. Links in the description. Which one should you choose? Choose a Roth IRA if you're young and in a lower tax bracket. You'll likely earn more later, so paying taxes now at a lower rate makes sense. You expect tax rates to increase in the future. You lock in today's rate and avoid higher taxes later. You want tax-free withdrawals in retirement. No RMDs, no taxes, complete control. You want flexibility to access contributions if needed. Choose a traditional IRA if you're in a high tax bracket now and expect to be in a lower bracket in retirement. The tax deduction saves you money today, and you pay less later. You need to lower your taxable income this year for other financial benefits. You're close to retirement and won't benefit as much from decades of tax-free growth. For most people under 40, the Roth IRA is the better choice. You're likely in a lower tax bracket now. You have decades for tax-free growth, and you avoid RMDs and future tax uncertainty. For people over 50 in high tax brackets, a traditional IRA might make more sense, especially if you expect lower income in retirement. Can you contribute to both? Yes, but your total contributions across both accounts can't exceed the annual limit. If the limit is $7,000, you can split it, $3,000 to a Roth, $4,000 to a traditional, but you can't contribute $7,000 to each. Some people use both strategically. They contribute to a traditional IRA to get the tax deduction, then do a Roth conversion later when they're in a lower tax bracket. This is advanced planning and requires professional guidance. Roth IRA conversions. If you have money in a traditional IRA and you want it in a Roth, you can convert it. You'll pay taxes on the amount you convert, but once it's in the Roth, it grows tax-free forever. This makes sense if you're in a low-income year, job loss, sabbatical, early retirement, and can convert at a lower tax rate. You expect tax rates to rise and want to lock in today's rate. You want to eliminate RMDs and leave a tax-free inheritance. Conversions are a powerful tool, but timing matters. Work with a CPA or financial advisor to plan conversions strategically. For timeless investing principles that apply to any retirement account, read The Intelligent Investor by Benjamin Graham. It's the book Warren Buffett credits with shaping his philosophy. Links in the description. Your next move if you don't have an IRA, open one this week. For most people, a Roth IRA is the best choice. Open an account with Vanguard, Fidelity, or Charles Schwab. Fund it with your first contribution. Set up automatic monthly transfers so you're consistently investing. If you already have a traditional IRA and you're wondering if you should convert to a Roth, run the numbers. Calculate what you'd pay in taxes on the conversion and whether it makes sense based on your current and future tax situation. The key is to start. Whether you choose Roth or traditional, contributing to an IRA and investing consistently is how you build long-term wealth. That's wealth mode. If this video was helpful, please click the subscribe button and then like and share with your family and friends.